stop what you're doing. Seriously, if you own NVIDIA, AMD, or literally any of the big AI darlings, you need to hear this 5-model valuation breakdown. Because right now, everyone is completely distracted by flashy processors and trillion-dollar market caps. But they are totally missing the fact that one single, under-the-radar company is actually bottlenecking the entire AI revolution.
Last week, I ran this stock, Micron Technology, through 5 rigorous valuation models and 2 legendary investor checklists. And honestly, what I found shocked me. When you cut through all the hype and just look at the hard data, my updated discounted cash flow model points to a staggering 121% intrinsic value upside.
That means we're looking at a specific fair value target of over $930 a share. No joke. This completely redefines how Wall Street should be pricing this company's future earnings power.
To really understand why, you've got to look at the AI market like it's the 1849 gold rush. Everybody wants to mine for gold, right? And companies like NVIDIA, well, they're the ones selling the million-dollar pickaxes. But high bandwidth memory, or HBM, that is the mandatory toll road everyone absolutely must cross to reach the gold mine itself. Without it, those million-dollar AI data centers literally cannot function. Micron is building the only functional toll road to the gold mine itself.
Now, I know exactly what you might be thinking. You've been burned by the boom and bust cycle of hardware stocks before. It's a massive pain point. You're probably terrified of getting crushed by cyclicality again. But I have to ask you, are you willing to let the greatest wealth-building supercycle of the decade pass you by just out of fear? By the end of this explainer, you're going to have a clear, actionable framework you can essentially steal for your own portfolio. We're going to see exactly why Micron's gross margins just exploded to 74%. And together, we'll figure out if this stock is the ultimate Peter Lynch growth at a reasonable price play, or if it's just another massive cyclical trap waiting to spring. Okay, let's dive right into this AI memory bottleneck. When we look at the high-bandwidth memory market, the capacity is incredibly concentrated. We are talking about just 3 players. SK Hynix currently dominates with 62%, followed by Micron at 21% and Samsung trailing at 17%. And the total addressable market here, it's projected to hit a whopping $100 billion by 2028. That is accelerating way faster than anyone previously expected. And this bottleneck is severe. Across all 3 of those major suppliers, HBM capacity is entirely sold out straight through the calendar year 2026. Sold out. This shortage is so extreme that it's actually bleeding into completely different markets. NVIDIA is reportedly looking to cut their gaming GPU production, like the RTX 50 series, by up to 40% in the first half of 2026, just to manage constraints with GDDR7 memory. The AI data center is literally cannibalizing its own supply chain. Now, what's really interesting about this is how that exact bottleneck translated directly into Micron's blowout second quarter earnings. I mean, they completely rewrote their own record books. Micron hit all-time highs across revenue, gross margins, earnings per share, and free cash flow. To really put this turnaround into perspective for you, just a year prior, they had a negative net cash of $4.8 billion. They ended this quarter with a staggering $16.7 billion in cash and investments. Talk about a comeback. Total revenue for the quarter came in at nearly $23.9 billion. That is an insane 196% year-over-year growth. But here's the most crucial thing to understand. This wasn't driven by just flooding the market with more product. DRAM bit volume, which is just the actual underlying amount of memory shipped, only rose in the mid-single digits sequentially. That explosive revenue? It was driven by a mid-110% increase in average selling prices. They possess absolute, undeniable pricing power right now. And all of that leads to a profound structural shift in their business model. Historically, memory suppliers relied on these one-year long-term agreements. That approach led to wild, unpredictable volatility for the whole sector. But Micron is executing a totally different playbook today. They're signing multi-year strategic customer agreements, or SCAs, which lock in specific price and volume commitments. During the quarter, they actually signed their first ever 5-year SCA. This takes them from transactional commodity purchasing to contracted infrastructure supply. It fundamentally changes the volatility profile of the entire memory industry. This pricing power directly builds out their strategic moat. Technologically, their next-generation memory chips, like the 1-gamma DRAM and G9 NAND, are ramping into production faster than ever before. But critically, you have to look at their manufacturing footprint. With the ongoing war in the Middle East threatening global helium supplies, which are absolutely vital for competitors like Samsung and SK Hynix, Micron's expanding domestic U.S. manufacturing base in Idaho and New York suddenly insulates them from severe geopolitical supply chain disruptions. Now, while HBM is definitely the star of the show right now, the broader NAND market is also thriving. It surged to a record $46 billion this quarter, mostly driven by AI enterprise solid-state drives. And while the Chinese competitor YMTC is definitely seeing rapid growth fueled by their own domestic demand, Micron and the other top players still maintain a very solid grip on the global market. The AI tailwind is simply expanding the pie for everyone.
But to be fair, we have to look objectively at the bear case here. Let's call it the Ramageddon risk. Skyrocketing memory prices are amazing for Micron's margins, sure, but they threaten to destroy demand in price-sensitive consumer segments. We could literally see the sub-$500 PC market practically disappear by 2028 because budget models simply won't be able to absorb these elevated memory costs. Plus, there's the cyclical risk. Micron is spending over $25 billion this year on new fabs. If AI demand cools down right when these new fabs flood the market with chips around 2028, we could see a pretty painful capacity glut. So the crucial point is weighing these risks against our valuation framework. Does this pass the Warren Buffett test? What we clearly see a widening note, a secure US-based supply chain, and undeniable pricing power. What about the Peter Lynch test? This looks exactly like a growth at a reasonable price play, backed by multi-year locked SCAs. The financial projections are just immense, an estimated $109 billion in fiscal 2026 revenue with 74% plus gross margins. And that bear trap of a capacity glut we just talked about, it's heavily mitigated because HBM carries a 3-to-1 trade ratio, meaning it eats up 3 times the wafer capacity of traditional DRAM, which keeps overall memory supply permanently constrained. So, when we plug all of these accelerated realities into the discounted cash flow model, recognizing that this is a structural shift with multi-year contracted pricing, not just a brief cyclical peak, the updated fair value target lands at $934 per share. Let that sink in. This represents a fundamental re-rating of Micron's earning power going forward. The simple truth is this. Memory is no longer just a cheap, swappable component. It is the defining strategic asset of the AI era. So, are you prepared to capitalize on this Ramageddon supercycle, or will you let old fears keep you sitting on the sidelines? I challenge you to evaluate your own portfolio against the framework we built today and keep digging into the real fundamentals of the AI supply chain.